Everyone's talking about rental yields in Dubai right now. You hear 8%, 10%, 12%. These numbers get thrown around constantly by agents trying to sell you something. But here's what nobody tells you. The area doesn't determine your yield. The building does. The purchase price does. The way you operate does. I've seen investors in JVC making 11% net, and I've seen investors in the exact same building making 5%. Same apartment, same views, completely different approach, and completely different results. Today I'm going to show you the 5 areas where we're actively looking for deals right now. And more importantly, I'll show you exactly what separates the investors making real money from the ones losing it. Let's get into it. The first group of areas I want to talk about are JVC, Arjan, and Motor City. And I'm grouping these together because fundamentally, they share the same tenant profile and investment characteristics. These are the highest yielding areas in Dubai right now, and there's a good reason for that. Affordable entry prices, central locations, and massive tenant demand from working professionals who want to live somewhere nice without paying marina or downtown prices. If you look at a map, JVC is about 20 minutes from downtown, 15 minutes from marina, 20 minutes from Palm Jumeirah. You're essentially right in the middle of everything, which is exactly what tenants want. But here's what most agents won't tell you. Not all buildings in these areas are created equal, and this is where most investors completely mess up their returns. Let me give you a real example. The average rent in Aljan for a standard one-bedroom is around 70,000 dirhams per year. That's the area average across all buildings. But in premium buildings from strong developers, the exact same size apartment, same square footage, same layout, rents for 90 to 95,000 dirhams. That's an extra 25,000 dirhams per year, about 35–40% more income just by being in the right building. In JVC specifically, we look at buildings like Bingati Stars, where service charges run about 12 to 14 dirhams per square foot, or Bloom Heights at 13 to 15 dirhams, or Hayati Residence at 11 to 13 dirhams. These buildings have proven rental demand, and we're seeing net yields between 9 and 11% when you buy below market and operate on short-term rentals. But we completely avoid buildings like Le Grand Chateau, where service charges are above 20 dirhams per square foot with poor management, or Fortunato, which has had ongoing construction quality problems. To put those service charge numbers in perspective, on a 1,000 square foot apartment, the difference between 12 dirhams and 20 dirhams per square foot is 8,000 dirhams per year coming straight out of your pocket. That's money that should be your profit. Entry price for a one-bedroom in JVC right now is somewhere between 650,000 to 850,000 dirhams. If you find a motivated seller and negotiate 10–15% below market, you're looking at under 750,000 for a solid unit in a good building. The second area we're actively looking at is Business Bay. And this is interesting because it's where corporate demand meets tourist demand. You've got business travelers coming for meetings and conferences, families visiting downtown who want to be close without paying those crazy downtown prices, and professionals who want Burj Khalifa views at a more reasonable entry point. What makes Business Bay tricky is that the range of building quality is absolutely massive. You can have 2 buildings right next to each other, one making investors great money, the other bleeding them dry through service charges. Let me give you a real example of what happens when you buy wrong in Business Bay. Damac Paramount Towers. 4 Hollywood-themed towers with stunning brochures and Burj Khalifa views. Sounds great, right? Construction started in 2008. Damac promised handover in 2012. Actual handover? October 2018. That's 10 years to complete something that was supposed to take 4. But the timeline isn't even the worst part. Service charges at Paramount are 29.36 dirhams per square foot, among the highest in all of Dubai. On a 3-bedroom apartment of about 1,700 square feet, that's roughly 50,000 dirhams per year just in service charges. Before your mortgage, before maintenance, before anything else. One investor bought a 3-bedroom there in 2018 for 4 million dirhams. By 2020, and this wasn't COVID, just a normal market correction, the value had dropped to 2.8 million. That's 1.2 million gone. Add 2 years of service charges at 50,000 per year, another 100,000 dirhams. Total damage? 1.3 million dirhams lost on a premium development. That's exactly why we don't chase shiny new buildings. We buy older towers that are 8 to 12 years old with proven management and service charges in the 12 to 15 dirham range, because that's where the real returns are. Entry price for a 1-bedroom in Business Bay right now is between 900,000 to 1.4 million dirhams, depending on the building and view. We target motivated sellers and aim to buy at 10 to 15% below those prices. Net yields on short-term rentals in the right buildings run between 7 and 9%, and the mix of corporate and tourist demand means strong occupancy throughout the year. The third group is Dubai Marina and JLT, and these are the most established short-term rental markets in Dubai. Highest tourist demand, beach access, metro connectivity, restaurants and cafes everywhere. But they're also the areas where the gap between smart investments and terrible investments is the widest. So you really need to know what you're doing. Let me show you what I mean with some current market data. Right now in Dubai Marina, off-plan properties are selling at around 3,470 dirhams per square foot. Ready completed apartments in the exact same area, same marina, same views, are selling at 1,810 dirhams per square foot. Do the math on that. Off-plan buyers are paying a 92% premium for something that doesn't exist yet. Almost double the price for a brochure and a rendering. Why would anyone do that when they could buy a completed apartment, renovate it properly, and start collecting rent in 60 days? They shouldn't. And that's exactly why we only buy secondary market. In Marina, we target buildings like Marina Gate 1, 2, and 3, where service charges run 14 to 16 dirhams per square foot and net yields are around 7.8%. Marina Promenade runs 13 to 15 dirhams with yields around 7.3%. Marina Wharf is 12 to 14 dirhams with yields around 7.4%. These are proven buildings with strong rental demand and reasonable operating costs. But we completely avoid certain buildings, and I want to be specific because these mistakes cost people real money. Marina 101, construction started in 2007 and still isn't finished after 18 years. Banks are owed 427 million dirhams. Investors are trapped. Current resale transactions show units going for 800 to 1,600 dirhams per square foot, while completed buildings right next door trade at 1,800 or higher. People are taking 50% losses just to escape. We also avoid elite residents because short-term rentals are heavily restricted, and Manchester Tower due to construction quality issues that affect both tenant satisfaction and resale value. Same marina, completely different outcomes depending on which building you choose. JLT follows a similar pattern. The DMCC free zone creates constant demand from professionals. Entry prices are 900,000 to 1.4 million for a 1-bedroom, and net yields run 7 to 8% on short-term rentals when you buy the right building. The fourth area covers downtown Dubai and Dubai Creek Harbor, and these are premium locations that attract a specific type of tenant. Downtown is the iconic address, Burj Khalifa views, Dubai Mall access, the fountain shows. Tourists will pay a premium to stay here, and occupancy rates for well-operated short-term rentals are consistently strong. The challenge with downtown is the entry price is higher, usually starting around 1.5 to 2.2 million for a 1-bedroom. So your yield percentage looks lower, even though the absolute cash flow can be strong. Net yields on short-term rentals in downtown typically run 6 to 8% depending on the building and view, but the quality of guests tends to be higher, and properties hold their value well. Creek Harbor is newer and still developing, which means we're more cautious there. The infrastructure is coming along. You've got the Dubai Creek Tower project, retail, and waterfront development. But it's not as established as downtown. For both areas, the same principles apply. Buy from motivated sellers. Target older buildings with reasonable service charges, and avoid anything where the operating costs eat into your returns. The fifth category is what I call emerging opportunities. And these are areas where we're watching closely but being very selective. Places like Expo City, Dubai South, and some of the newer master communities have interesting fundamentals. Government backing, infrastructure investment, upcoming demand drivers. But they're predominantly off-plan right now. We don't buy off-plan. You know that if you've watched my other videos. But what we do is watch for motivated sellers. When handovers start happening in these areas, there will always be investors who bought off-plan and now need to exit. Visa issues, divorce, changed circumstances, they bought more than they could afford. These sellers will accept 10 to 15% below what they paid just to close quickly. Their loss becomes your yield. The key with emerging areas is patience. Don't buy into the hype. Wait for the secondary market to develop, then move in when you can get a real discount on a completed, rentable asset. So those are the 5 areas and categories we're actively looking at for rental income in 2025 and 2026. JVC, Arjan, and Motor City for the highest yields, but building selection is absolutely critical. Business Bay for corporate and tourist demand, but avoid the service charge traps. Marina and JLT as the most established markets, but only secondary market, never pay double for a brochure. Downtown and Creek Harbor for premium positioning, and emerging areas where we're watching for motivated sellers as handovers happen. But remember the core message. The area doesn't determine your yield, the building does. The purchase price does. The way you operate does. If you want to discuss any of this in more detail, specific buildings, specific numbers, whether a deal you're looking at actually makes sense, WhatsApp me. Link is in the description.